Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. The break in early October below the August to October ascending wedge pattern highlighted in blue on my daily chart has been the most recent seminal moment here. 5 weeks ago I laid out two avenues of what I thought might be the possibilities here for the future following this move lower. Of these two, the first avenue is the way the market is moving lower. To recap my thoughts, here's what I said at the time, and I quote, "The first is a straightforward move down with potential targets for the ascending wedge pattern. Thus, a primary target X on the downside has already been achieved in the 860 area, whilst the secondary, harder to reach target X1 is way down below in the 712 area." End of quote. We're now below all the moving averages, and this week prices have significantly slipped below the recent August low, such that this past Tuesday had the lowest low and low close since late September 2021. The market dipped as far as just below the March 2014 high at 724, which is just ahead of the support at October 2013 low at 721, and with nothing below in the way to stop that market reaching the harder to reach secondary target 712 for the ascending wedge pattern. Below target X1 we have the January 2021 high at 693, and then the hugely significant 50% absolute Fibonacci line at 682. Now you may think it would be an easy hop down to these levels given what the market has already managed, and you may well be right, but I would just like to point out the following. Should prices start holding where we are now, above the old August low, as well as the January 22 low, and even down as far as the target X1, then there could just be the possibility of a very large double bottom. It is currently a remote possibility, but it would be remiss of me not to mention it, so caution. Chicago corn. Here are some of the key elements from my comments formed over the last few weeks. The first element is the reverse head and shoulders pattern over July and early August. It turned out to be a good one, especially the slightly optimized neckline currently at 722, which had been incredibly supportive until the start of November. This led the market higher into a new pattern. Secondly was the impact of the long moving average, currently 694. This earlier had tried to cap the market, but as it separated from the 50% Fibonacci line of the September 2021 to April 2022 move at 661, its efficacy as resistance was being questioned. 5 weeks ago, it became both support and resistance, and 4 weeks ago, purely resistance. Finally, and most important of all, there is the pattern which the reverse head and shoulders pattern led prices into. The July to October ascending wedge pattern, highlighted in red trend lines on my daily chart. I personally found this the most elegant of all the elements. In mid-October, the market exited this pattern, and for a couple of weeks it seemed the prices were looking to see if there was enough bearish pressure out there to push prices lower. Well, 4 weeks ago, we found there was. Hence, I initiated a primary target X for the break below in the 648 zone, with a secondary harder to reach target X1 in the 550 zone. Late last week, prices had dropped down enough to reach the primary target. I would like to discuss that move down last Friday, as it was potentially hugely important. So over last Thursday and Friday, the market punched down and closed below what appeared at the time to be a strong triad of support, consisting of 1. The 50% Fibonacci line of the September 2021 to April 2022 move at 661. 2. A little below that, the gently curling higher medium moving average, currently 662. And finally 3. The lower time, currently at 664 of the September 2021 to July 2022 bullish Andrews pitchfork. The move lower can be quantified in one of two ways. Either this triad was strong but the bearish pressure was stronger, or the support was only on the surface strong and in reality the triad was weak. I am minded to think the former, a much stronger bearish pressure, spent itself out and there is little or maybe even none left. You see, as I said last week, and I quote, the question now is very much, will 648 hold or will prices continue lower? If they do move low, well, we don't have much below until the two lesser Fibonacci lines in the 622 zone. However, there's potentially another target below, target X2 in the 627 area. This is the potential target for the very late October to date action, being a possible bearish halfway hesitation. This is only becoming clear now, but it would be an interesting stop-off point on the way down to target X1 in the 550 zone. It all would depend on what happens in the 648 zone. End of quote. Since that initial move lower, which finished with a key reversal up this past Wednesday, well, it raises the question as to whether the market has indeed spent its fuel on the big move lower at the end of last week. For this reason, I've decided to keep the broken bullish Andrews pitchfork still in place for a little while longer. And it is also for the same reason that I've drawn a new, shallower bullish shift pitchfork for the same move. You can see this highlighted on my daily chart in purple. At the moment, we are in between the lower time, currently 590, and the middle time, current 730, for this pattern. One final thing to note. Something I highlighted might happen last week, and has happened. We had a weekly key reversal down last week. Something to consider amongst all the other factors listed earlier. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. Here comes the final bit.